Hi there, my name's Mark Gardner from MPC Markets. Just going to run you through the July buy the dip strategy in the S&P 500 index, where the strategy lets you stop guessing and let the strategy do the work. General advice warning, the disclaimer, the content presented is intended for informational purposes and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be your sole resource in making investment decisions. Please note that past performance is not a reliable indicator of future results, and this product involves derivatives and 100% of capital is at risk. Okay, so we're looking at the S&P 500. I'm not going to explain indexes to you. Everyone knows, I'm assuming, what an index is, and if you don't, obviously go and do your own research on that. But at the S&P 500 at the moment, we have multiple valuation alerts. So we've got the Shiller CAPE, which is the cyclical adjusted PE ratio. Current value around 41.97. Now, the overvalued threshold is above 20 there, so we're signaling overvalued. Trailing PE, forward PE, also flashing overvalued. Trailing PE particularly at 32.44. And the Buffett Indicator, which is GDP to market cap ratio, is currently at 235.6. Now, that is usually overvalued at above 150, where it's severely overvalued and record levels here at the moment. Add to that, and geopolitical issues with Iran, midterm elections coming up this year, and we are at one of those periods where it is quite risky to be putting more money into the index up here. When all of these indicators have been at these levels historically, we've seen at least one 10% plus pullback, more than 70% of the time. Now, add to this midterm election cycle. So we have the midterm election in November this year. Since 1939, so that's obviously 86 years, we've had a pullback in the S&P 500 from the intra-year, so the record high during the year, of 16.7 on average, and we've had a pullback every single midterm election cycle since 1939. Now, the average one-year return after the low is 36.5%, and the low occurs in May to October window, around about 80% of the time. So the midterm year positive rate since 1940 is still around about 86%, but obviously there's that uncertainty coming into who's going to be running Congress, who's going to be running the Senate, and what sort of policies are going to be made. And you add to that the current inflation, the bond yield environment, Trump uncertainty as well, and Trump and the Republicans actually, trailing in the polls. This is going to be one of those cycles where volatility is quite high. The rebound in the last 15 years has been really fast. So we had situations like the GFC and the Dotcom bubble where we got back to break-even levels, sometimes up to 500 days after after we basically hit the lows. Since 2015, the average days to break even from bear markets is only 127 days now. And 83% of the time in rolling 3-year windows since 1928, we've had positive returns. So the average rebound across the 11 major corrections over 24 months has been about 41%. And you can see here the COVID crash was one of the bigger ones. Was a 75% bounce. The average post 2015 is around about that 41% mark. So buying the dip happens, but as we all know, it's very hard to buy that dip. So this is where we like the buy the dip strategy because it effectively does it for you. So we have a 6-month look back window generally, and November, this peak period here between sort of May to November is where we want to put this. So this one in this example that we're running right now for this current strategy in July is a July to November window. So it's slightly shortened because we just want to keep that period up until November. And we nominate a day in the week, and then the S&P 500 settlement is monitored. That is your contractual entry price, the single lowest, for example, Monday settlement in that window. And then after November 2026, the observation period ends and your entry price is then set. So just a quick warning as well, because we're looking at putting in, for instance, for $100,000 notional exposure, you're putting in around about $17,000 in cash. We're not, say, if you're selling out of an S&P 500 ETF for $100,000, we're not saying you should put $100,000 into this. We're saying you should match your exposure from a notional perspective. But it is 100% of your cash that you invest, the $17,000, is at risk, and you can lose all of that cash. However, obviously, 100% of your cash equals 17% of your notional upside exposure. So how buy the dip works in scenarios. So we've got basically, if we had a time machine and we went back exactly 3 years from July the 7th this year, this is how it would have worked. So the commencement date was 7th of July, 2023. The S&P was at 43.98. And then over the observation period, you can see in green here, the 6 months, the 27 weekly closes. The initial look back level on the 27th of October gave you an entry price of 4117.37, which was 6.4% better than your entry if you were just to enter in July. And then obviously the rest of the strategy plays out. And if you were to take the strategy all the way to maturity on the 7th of July, 2026, you would be out at 75.03, 82.25 performance coupon. So that's how it would work if we had a time machine and went back exactly 3 years from now. So I'm not going to show you the good side without the bad side. So the other side of the story is where this strategy doesn't work particularly well is when we don't get the dip, and B, when we have the market have a severe drop like it did in COVID in March 2020. So in this scenario, step one, and there's your observation period, the initial look back level was only a 0.44 better entry. The maturity level, unfortunately, because of this massive dip over COVID, meant that you lost all your capital. Obviously, if you had an S&P 500 ETF, you possibly could have held on to that. But on the flip side as well, you can exit this early. The closer to the expiry date, the better the price. But you can exit early if you wanted to. So in this scenario, if you decided to sell your S&P 500 at any stage, you can do the same in buy the dip as well. So if you're one of those people who think that we've got the Dotcom bubble coming or AI as a bubble, this is where the strategy actually works better. So, and it may surprise you, but the observation period here, and we're going to go back to July the 9th, 2001. The commencement date price was 1,198 in the S&P. Hard to believe. Now we're at 7,500. And obviously, the September 11 attacks happened around, a few months into our observation period. And then we actually got an initial look back level on the 24th of September 2001 at a roughly 1,003 in the S&P. So that was 16.29% better entry than if you actually just allocated in July of 2001. Then we've got the dot-com bust lows. And at this point, if you're holding an S&P 500 ETF, you're down around about 51%. So you're staring at an ETF that you put $100,000 into, and it's showing $49,000. Obviously, in this scenario with buy the dip, you've only allocated $17,000 to get that exposure. So you're just down $17,000. Which is a hell of a lot better than being down $51,000 at those lows. And look, if you've held on for the 3-year period, the maturity date was here on the 9th of July, 2004, back at 1,112.81. You've actually made money on that performance coupon towards the end of the 3-year period. So in that scenario, it is actually, you're actually showing a lot less risk. And I'm going to explain it to you in this way. What we do here at MPC Markets is we have the modern wealth formula. So the old way you did things was the traditional method, say the 60-40 portfolio. So in your growth, you've got that $100,000 invested in the S&P 500 index ETF. And then you've got $150,000 in income over is your general portfolio makeup in that old traditional 60-40 method. So what we're taking advantage of here with the new modern wealth formula is we're lowering our risk because we are being very capital efficient with our growth side. So at worst case scenario, the cash required to represent that same growth in the S&P 500 index ETF, you only have to allocate $25,000, or in this case, just $17,000 to get that same $100,000 exposure to the upside. So that leaves you with saved cash. And that's say, for instance, on this example of $100,000, at $75,000 extra, you've got to allocate to increase your income part of your portfolio. Now, income part of your portfolio is far more risk-free, far more consistent, and would smooth the overall investment portfolio for you without sacrificing any of the return to the upside. And this is what we like about doing it this way in this new modern wealth formula. So if you want to have a look at that, there is another video that you can get, which there is a QR code at the end. But why buy the dip now? Look, valuations are at highs, clustered risk, geopolitical, oil, inflation, recession odds, etc. The midterm dip, you're getting 6 odd times the leveraged upside. You're going to lock in a look back at the lowest price in the next 4 odd months. And then we all know that Trump's got policy tailwinds. The man is very focused on the stock market being up, and he'll probably want to have the stock market up by the end of his term. And that happens to coincide very, very well with this 3-year buy the dip strategy. If anything, we may even look to exit around about 5 to 6 months out from the actual maturity of this as we come into a new president in about 2.5 years' time. If you'd like to know more about the modern wealth formula, simply scan the QR code here, and we can essentially you can move what you want to allocate to your growth or to your income, catered to your particular situation, and you can build, protect, and compound the same way you've been doing, but just in a far more efficient way. Thanks for listening, everyone. And if you've got any inquiries, please contact us at mpcmarkets.com.au.